Rick, how you doing?
Hey, Megan. Good. I'm in the car today. Pretty cool, right? Change
I
of
know,
environment.
I know. I do like that car. I really do. I
It's
just
fun to
can't
drive.
imagine. I always said when my kids were little, I never wanted to have anything that I would get like stressed out about if
Hmm.
they, had dirt on their shoes or whatever. We're kind of a dirty group. Tim's a contractor.
Yeah, right.
I have, the horses, and then we have to take the dog everywhere. That
Hmm.
interior looks so pretty, but something tells me there's no dog that rides in there, and you're typically a pretty clean guy.
Yeah, I'm still looking for a McDonald's French fries somewhere near. I just know there's somewhere, some French fries somewhere in the seat.
Somewhere saved for later.
Yeah, exactly.
Oh my gosh. Okay, so today we've got, tell us about our topic.
Well, a couple of things. There's some actually good news today in the mortgage business. So let's talk about that for a minute.
I would love
Let's
some
talk
good
about,
news because it's been kind of
yeah,
bad news for the last week. So go ahead.
yeah. So let's do that. Yeah, for sure. So FHA. FHA has their own version of PMI. They don't call it PMI, they call it MIP, which stands for Mortgage Insurance Premium. So let's talk about why FHA even has MIP. And they do it monthly, like everybody else. So FHA is a HUD, is really HUD, it's a government sponsored agency. So when lenders fund FHA loans, HUD ensures or guarantees that loan against loss or foreclosure.
Mhm.
And so that MIP, that monthly MIP goes into a reserve fund to cover losses on foreclosures. So essentially what it does. Years and years ago, they were really underfunded on that reserve, and they raised the MIP, monthly MIP to 8.85%. Now they've got more than 5 times the amount that they really need to cover the reserve. So they finally decided maybe we should cut that back a little, right? Come on,
Mhm.
5 times more they need. So now they cut it back. So now it's cut back to 0.55. And so what does that mean to our home buyers? Well, here's what it means. Their point is actually 0.5. And a $600,000 mortgage, that saves the buyer $3,000 a year,
Oh, that's wonderful.
right? So it's a good savings.
I
I'm
love
sorry,
that.
I'm sorry, it's wrong. It's 1,800, it's a 30 basis point. It's actually, it's $1,800 savings on a $600,000 loan. So that's a good savings, $1,800
I
a year
love
on a
it.
$600,000 loan. So that's
Yeah,
great.
because that is, let's see, $150 a month. Heck yeah.
Yeah, it's a good savings. That makes a big difference on qualifying, right?
Mhm,
And
mhm.
FHA is a great loan because unlike compared to conventional mortgages, you can have, lower credit scores. You can have higher debt ratios. We'll talk about debt ratios, our topic today, but you can have a higher debt ratio and lower credit scores and still get a really, really great rate compared to a conventional mortgage. So FHA serves a really great purpose in the home buying community to help more families buy homes. And that's what they were designed to do when they came into existence, I think back in, gosh, I want to say in the 30s. I
Mhm.
can't recall the date, but it was a long time ago. So that's the whole idea behind HUD or FHA is to help more home buyers or more families buy homes. And so they're more generous or more lenient on the qualifying.
Mhm.
So it's a
You're right.
great
It was
product.
1934.
There we go.
That's how we bought our first house, FHA.
Yeah,
We wouldn't have been able to buy a house if we had to put 20% down. I mean, we had
right.
3% down. Back then it was 3%. It wasn't
Mhm.
3.5%. And,
Right.
and then we had to borrow the money for our closing costs. We had like no
Mhm.
money. We were just young kids trying to make
Yeah.
our way. And
Yep.
thank God for that, because then we were able to become homeowners, get our foot in the door.
Exactly. That is exactly the reason why FHA came into existence because prior to FHA, home buyers like yourself, way back when, there was no way to buy a house. You just couldn't
Right.
do it. FHA opened those doors to home ownership, and they still do. And so it's a very, very good program. Don't shy away from the product at all because people think they've got to say a 620 or 640 credit score, they can't buy a house. FHA, they can buy a house all day long. It's a great.
I love that. That's good news. Yeah, I haven't seen an FHA loan in a very long time, which is so
Yeah,
weird, because we
yeah, we
have,
need to see more of those in Orange County. We really do. Yeah, I'd
yeah,
like to
we
see
do.
more of those.
We
Yeah.
do. Okay, let's talk about the topic. Let's hear it.
Yeah. So the three essentials that lenders look for when approving a loan.
Three
There's,
essentials that lenders look for when they're approving your, so these are the top three things that they look for. All right,
the
let's hear it.
primary three things. Loan to value. Let's talk about what they are first. Loan to value, debt to income ratio. We call it DTI in the business. And then credit history. Okay. So what is loan to value? Well, loan to value is really your down payment. So if you're putting 10% down, let's say, for example, your loan to value is 90% of the purchase price. So let's, in simple numbers, you have a $100,000 house, you're paying 10% down, your loan amount's 90,000, your loan to value is 90%.
Got
Okay, you
it.
can put 25% down, the same thing happens. So that's the down payment.
So that's the first thing they evaluate is how much down payment you have. How much skin in the game do you have? Okay, go ahead.
FHA, of course, is 3.5%. Great product. VA, well, we don't talk about that a lot, but we should. VA is a zero down payment loan. It's 100% loan to value on VA. A lot of VA loans. We should really do more of those. That's another topic. But so 100% loan to value on VA, 97.5% on FHA. You can also go on a conventional mortgage as low as 3% down. And that's also a great product. So there's lots of great opportunities right now in this market, Megan, to buy homes with a low down payment, 3.5% down FHA, 3% down conventional, 0 down VA.
It's probably a better deal though to do the FHA if you're going to be doing less than 5% down with this reduced MIP.
Possibly. Sure. That's the bill well, because if that buyer has a 660 credit score and a 3.5% down payment, they're going to get a great loan.
Yeah.
Much better than conventional.
All right. So the first thing
great opportunity
is your loan to value, how much skin you've got in the game. Okay. What's the next thing?
Debt to income ratio. This is really, really critical. And so what is a debt to income ratio, or DTI? What that is, you take into account all of your credit obligations. Those are things on your credit report. Like things that don't count, for example, like your cell phone bill doesn't count against that. Your utilities don't count against that. It's all your credit debt. Okay. Also, that would also include things like spousal or child support. That's also a debt they would include, but essentially it's credit debt. So you take your total monthly house payment. The house payment would be your principal and interest, the mortgage, your property taxes, and your homeowner's insurance. That's your payment. Add on top of that, all of your credit obligations, car payments, credit cards, installment loans. Take that number and divide that by your gross monthly income. That number gives you the DTI, or debt to income ratio.
Your gross monthly income. So for everybody, that means your gross monthly income. So the amount on your check that you didn't get before they took everything out.
Correct. It's your income. It's your income before all the taxes are taken out.
Yep.
Deductions. Okay. So people, it used to be years ago, the guideline was like a 38 to 40% debt to income ratio was kind of the guideline. In recent years, that's changed a lot. Typically, you can go as high as a 50% debt to income ratio. And so what that means is that if your total house payment and your total credit obligations are, say, $5,000 a month, you can make $10,000 a month and still qualify in most cases for the mortgage. So let's talk about where loan to value and credit come into play with respect to DTI. When you have a bigger down payment and you have a higher credit score, you can push those ratios higher. So for example, if you're a 740 credit score and say a 10% down payment loan, you can typically push that to a 50% debt to income ratio. On the other hand, if you're doing a 3% down or a 5% down and your credit score is maybe 670, you're not going to quite be able to push to that 50% ratio. Okay, so that's why all those three things come into play. It's not just one thing that lenders look at, it's all three of those: loan to value, your credit, and your debt to income ratio. Those three things together. But they offset each other. So bigger down payment. Let's say someone's got a 30% down, but a lesser credit score, you can still push that ratio higher. So there's all those factors that come into play.
Perfect.
Yeah, so that's pretty much it.
No, that's pretty simple to understand. I like just going over three things because those are three things that are easy to remember.
Yeah, and it's so essential to the loan process. It really, really is. And we look at all three of those things when I'm talking to a home buyer, looking at those numbers. And then I get a pretty good idea really quickly where we can go in terms of how we can, push those numbers to a certain level if we need
Yeah,
to.
yeah, exactly. Well, good. Well, Rick, I appreciate you meeting us today remotely in your very fancy car.
I know, it's my new office. What do you think?
I love it. I know. It's like me everywhere I go. So I hope you
That's right.
stay dry the next couple days. There's a big storm
And
rolling
warm.
in.
I know.
And hopefully my horse won't have her baby this week while it's pouring rain and muddy and cold and disgusting out. So
no
keep
fun.
your fingers crossed.
We will.
All right. I'll talk to you next week.
All right, Megan. Thanks. Take care.
Talk to you soon.
See ya.